Welcome to Morningstar. I'm Larissa Fernand, and with me today is Professor Sanjay Bakshi, the Managing Partner at Value Quest Capital and the Distinguished Adjunct Professor of Finance at Flame University. Professor, I know you've been super busy and yet you carved time out of your schedule to talk to me. Thank you. Thank you so much.
Thank you, Larissa, and I love the stuff that you do. So thank you for inviting me, and I'm honored to be on your platform.
Thank you for your kind words. Okay, my first question to you is on tribalism, because tribalism is such an innate instinct. We all want to belong to a tribe. We all want to associate with, cohabitate with a tribe. How does this spill over in the investing world? Do you feel you have to belong to a tribe, to align to a tribe?
Well, the answer is yes and no, I think, because I'm a value investor, and even within the value investing field, there are different tribes. So there is the Graham and Dodd tribe, people who are more mathematically inclined and who rely on the mathematical cheapness of a situation or a business to find it attractive or otherwise. Then there is the Philip Fisher tribe, which is on mostly about the quality of the business, the competitive advantage it has. And these two tribes are actually quite different. These two people, when you talk to people who belong to the Graham and Dodd tribe and you talk to people who belong to the Philip Fisher tribe, you think that they are very different people, and they are in some sense, but there are a lot of similarities amongst all tribes in the value investing community. I mean, the similarities come from the basic principles of investing, that no matter which tribe of value investing you belong to, you believe in these three key ideas. And the single most important ideas are that one, the stock is that you're looking at is not a piece of paper. It's a claim on the assets and cash flows of a business. So there's a business underneath every stock and a bond. Second idea is that markets can often be very irrational. So you have to sort of be independent from the market. You don't use market prices to determine value. Your determination of value, no matter how you do it, is totally detached from what the market is doing. And the third idea is that the margin of safety, that you're looking for margin of safety. The sources could be different. For a Graham and Dodd tribe investor, it would come from it being an absolute bargain based on the principles laid down by Graham in his books. If you belong to the Philip Fisher tribe, it comes from the quality of the business, the durability of the competitive advantage, if it has any, and so on. So that's the key thing to remember, that you do want to be part of a tribe, but at the same time, there is danger of hanging out with people who are very similar to you. So you do need to look at other tribes out there, including people who don't believe in value investing. For example, people who do technical analysis. When I was young, I was very, very skeptical about technical analysis. And to a large extent, I still am. But I've seen some people who have done very well by combining fundamental investing with technical analysis. And they have effectively sort of jumped the jurisdictional boundary. They have combined value investing discipline with the techniques often used by chartists. And that's something to learn from, right? So you won't learn that unless you hung out with people who belong to a different tribe. So I do believe that the answer is both yes and no.
So when you talk of how you've evolved as an investor, do you feel to actually evolve, you have to keep your ego aside?
Well, if you don't, then you won't have a lot of money. You may have a lot of ego, but you won't have a lot of money left. Market is not a place for big egos. Absolutely. Yeah. There are other parts of the world in personal life where egos can play a big role, but markets are certainly not one of them, I feel.
So how do you see? That's another thing. We aren't built to disconfirm our beliefs, right?
Mm-hmm.
And we feel extremely threatened when someone does so in whatever sphere of life. So when it comes to investing, what principles do you use to keep questioning yourself, to question your assumptions?
Well, I think there are two aspects to the question, Larissa, that you asked. One is, how do you deal with this situation before you buy the stock? You're doing diligence, you haven't yet bought the stock. So how do you ensure that you are not going to just go by what your gut feel is, what you believe, and you're very careful about collecting the data and the information that you're gathering, and you're talking to the people who may have a different view, or you have somebody to talk to in your own office, a colleague, for example, who can play the role of a devil's advocate and challenge your notions. And But once the team has decided that, yeah, this makes sense, and we have done all the work and we looked at all the various moving parts and arguments in favor of investing and arguments against investing, and on balance, it does make sense to invest, and you go and make that investment. So that part can be taken care of with the help of a checklist. Absolutely, checklists are very important over there. But at the same time, there is the more important part of the question, I think, is that what do you do once you invest, and then there is new information that comes subsequent to your investment. Making an investment is just one decision, but you holding on to that investment or to sell it is a decision that you make every day. So, and all sorts of information is coming in. So you have to figure out a way to deal with this new information, especially if it is a negative information. Positive information is easier to handle, but if it is negative because it challenges your hypothesis, your notions, your own ego is attached to that situation. So, and there is a framework for that. The framework was designed by Thomas Bayes, a long time ago, and you have to basically train yourself to think like a Bayesian. And elements of that process requires you to be able to distinguish between what is important and what is not important. There are all sorts of information that come in which have low signal value. Most of it is noise. And as I think you will agree, the noise to signal ratio keeps going up given the world that we are living in. So you have to have a way to distinguish between what is noise and what is signal and discard the noise. And when it comes to signal, then you have to really focus on information which is important but will help you change your mind either ways. It'll either improve your conviction or dilute it. So you're really looking for surprise. So the amount of weight that you will assign to a new piece of information that comes in would depend upon whether it has a propensity to surprise you. So that's the important point to remember. And this part of the question that you asked, the second part, the new information coming in, that's, I think, more important, because it goes to the very idea that you have to challenge your notions. You have information that comes in, and you thought that this was the great business, but some shit happened. Things happen. COVID came, and you thought it was a great business, but it wasn't, because there was a stress in the economy, and so you change your view on that. Or you thought that you made a judgment about the people who run the business, and you thought they were great capital allocators, they had great integrity, and they had up until now, and you made that investment, but now they've done something which is seriously wrong, either in terms of integrity or in terms of a business decision that they have taken, which could be hugely risky, and if the risk did manifest, it could destroy the company. So you have to think about a framework as to how do you respond to this information. So I think that's what it is about. And unless, if you don't have that framework, you will end up in trouble eventually, because the world is uncertain, and there will be bad things happening to businesses that you have bought into, no matter what, how diligent you have been in the past. So that framework to help deal with negative developments subsequent to your purchase, I think, are a very key part of an investment framework.
Has it happened often to you that there have been negative developments subsequent to purchase?
Not often, but I mean, I would have liked it to be less often. Yeah, absolutely. But yeah, it has happened. And I don't want to say that every time it has happened, I have practiced exactly what I preach in the classroom. It's not easy. It's easier to teach than to actually practice it. You do get caught up with the emotional attachment. You do have words that you have spoken about that maybe in a public forum, and you want to stick to that view. And views are very sticky, so it's very difficult to remove the glue that is attached to the particular view you have. So it's not easy to do, no question about it. But yeah, you have to keep doing it, because if you don't do it, then you will have even bigger losses. Absolutely.
What's your view on the statement that investing is art and science combined? How do you view it?
I think it's a spectrum. So there are some basic principles that apply. I mentioned three of them in as part of the answer to an earlier question, and there are some aspects of science that you can apply. I mean, Graham laid them out in his book. So there are some basic principles of valuation that are applicable. I mean, things like the value of a debt-free business cannot be less than the value of the debt it can comfortably service, or the maximum value of all debt on a levered company's balance sheet cannot exceed the value of the same business which had no debt, the value of the whole business. So, the maximum value of the debt cannot exceed the value of the debt-free business with the same assets. Or the idea that there are bonds embedded inside stocks, and sometimes you can buy the whole thing for less than the value of the bond component. Now, these are like, esoteric ideas, and I don't think we have time to talk about them in detail. But they are as close to science as you can get, but you can't get much closer to that than this. It's not physics, and we are dealing with human beings. And I'm not talking about markets, I'm talking about even businesses, how businesses will do. It's not physics, it's not like the law of gravitation where you can precise, or the movement of molecules or atoms that you can predict with a degree of accuracy to the 10th decimal. You can't do that with human systems, and all businesses are at the end of the day human systems. So yeah, there is an element of art allowed to attach to it. There are all sorts of things that you can't quantify. I feel they're very hard to quantify, but they are important. Buffett wrote about the idea of risk, and he made fun of, justifiably, about what people in the academic finance refer to as risk, associating it with all the Greek letters, including the dreaded beta. And he had a framework. He said there are 4 or 5 things you have to think about when you think about risk. And risk to him meant the probability of permanent impairment. And he said there are 5 things to think about, and I'm not going to list them here, but they are things that you can't measure. You can only judge, and different people will have different views on that same subject. Then there are aspects about the corporate culture which are hard to quantify. How do they deal with customers? Are they willing to sacrifice near-term profitability to build a durable competitive advantage? If they have a very high margin on a business but the entry barriers are low, do they see that as a sort of a honeypot which will attract competition, and in order to deter competition they consciously lower the margin and pass on the benefits of scale, for example, to the customers? Nick Sleep has written about it in Scale Economics Share. So eventually, all these things do show up in the numbers, but you can't sort of lay them out on an Excel sheet, in my view. I think they are more of a management factor. You're really looking for people who have the longer view and are thinking about building long-term value instead of near-term earnings, and the willingness to sacrifice near-term profitability to build long-term value is a sort of a attribute which is a management factor, and I don't think it's easy to sort of quantify, at least not for me. I can't quantify it and put it in an Excel model.
Okay, so to extend that argument outside the spreadsheet, outside the numbers, outside the analytical mindset, what
Yep.
is it that you bring to the table? Do you bring gut feel? Do you bring spirituality? Do you bring does meditation help? Luck? How do you?
All of these things are important, I think, and no question about it. And I already spoke about things that are hard to quantify. You can't put them in an Excel model. On spirituality, as I'm 57 years old, and I'm more spiritual today than I was 5 years ago, and 10 years ago, and 20 years ago. And I think that's a common pattern. You do think about these things much more when you get older. And I find a lot of parallels between old spiritual ideas and and the world of investing. And very old ideas, ideas like equanimity. Equanimity is a idea that you should treat gains and losses as if they were just the same, and we call it loss aversion. Now in behavioral economics we have a concept called loss aversion, or the inability of people to treat losses exactly the way they treat gains. So but it's much before behavioral economics was created. There was the concept of equanimity. You find it in the Gita. You have in the Gita, there is a verse where Krishna talks about balanced mind. What is the meaning of balanced mind? Balanced mind means that you can take prosperity and adversity and treat them the same. If you study Dhammapada in Buddhism, they have a concept called upeka, which means basically equanimity, that you're being emotionally calm, balanced, and even. So these ideas are very old ideas, and they have withstood the test of time, and they have very strong relevance to the world of investing. And of course, we have turned them into concepts which are much more familiar to people who read books on behavioral finance and investing. I mean, if you look at even the idea of detachment, Gita's most famous words, I'm not going to repeat, everybody knows it, is about detachment, that, focus on your work, focus on the process and not outcomes. Now we call it process versus outcome in today's context. We think about investing, focus on the checklist, focus on the process, don't worry about the outcome. It's the same idea at the end of the day. Or you talk about the other ideas of detachment that you find in the Gita and other spiritual texts, that we can relate them to commitment bias or to endowment effect, falling in love with what you own. And all the spiritual texts tell you that don't do this. You have to be detached from all this. So it's all about how do you handle your ego. And if you can look at all the standard psychological tendencies that are there, which can make you go wrong, they eventually boil down to the ego. And if you look at all the spiritual texts, they talk about the same things, absolutely the same things.
How has your relationship with uncertainty evolved over the years?
Well, I used to be shit scared of it initially, and uncertainty means different thing to different people. In academic finance, uncertainty is related to risk, which is absolutely wrong. And I mentioned earlier, as part of an answer to your earlier question, Buffett has a framework when he talks about risk. So it does, uncertainty, is something where you can't predict, but risk is something where you are worried about permanent loss of capital. So academic finance is absolutely wrong when it associates risk with uncertainty. So I think what has happened to me over the years is I've learned the importance of what is called as asymmetric payoffs. Basically the idea is that the world is uncertain. You're going to toss a coin and you don't know it's going to land heads or it lands tails, but the outcomes are not uncertain. So there are situations where if it lands heads, you could win a lot of money. And if it lands tails, you can't lose anything or you will lose very little. And that's a good bet. That's a bet with an asymmetric payoff. You want to play that. You want to engage in those sort of bets, and the more you have, the better, because the role of diversification comes in. And value investing is exactly that. If done right, it does offer you asymmetric payoff, because if you've done it correctly, then you're basically ensuring that if you are invested in a strong business which may be going through a period of adversity, and therefore the earnings are not looking good as of now, and the markets which are myopic are looking at near term, they have brought down the value of the business and it's so very cheap. That's the kind of a setup that a value investor absolutely loves, because now, if you look at the future could be, there could be a turnaround in the industry, and if that happened, then the upside is very significant. But if the downturn continues because the business has a good balance sheet, because the competitors are much weaker, and so on, the others are going to get hurt far more than the business that you're looking at, and therefore the downside is limited. So for all sorts of reasons, whether they come from the quality of the business or they come from low valuation, value investing offers multiple ways of creating asymmetric payoffs for investors. And I think when you are able to do that, you want to seek that uncertainty, because you're effectively turning uncertainty into a friend, and seeking uncertainty on terms that are favorable to you. That's a good way to look at the world, that bad news can't hurt you, but good news could turn your business into a multi-bagger, for example. So that's a good setup to have.
So do these principles that you work by, do they spill over into your personal life? The way you spoke of uncertainty and good news or bad news and stuff like that?
Oh yeah, absolutely. I mean, you can't. I mean, it's not easy to sort of get out of your investing mindset and say, now I'm going to be a different person. Um, it does, and you always have that investment frame of mind. You're always looking at the world with an upside downside situation, or you're looking at the world with the lens of psychological tendencies that you're exposed to or other people are exposed to. So often I get into trouble when I do this. I remember my mother loves to bargain when she's doing grocery shopping, and the fruit vendor would come and she would be buying bananas, and she would haggle over a small amount of money, and I would say, well, what's the point? This amount of money that you will save is nothing compared to your net worth, for example. So you're giving into anchoring bias, and she would say, shut up, because I actually enjoy this. So the upside could come from non-monetary reasons. So you'd often get into trouble when you sort of over apply your investment mindset to personal life. Yeah, but by and large it does help a lot, because people come to me with problems and I ask them, help them think through the problems that they're facing, and the attachment they have to certain decisions in life and how to get out of those decisions. Exactly the same thing that we do in investing. You are invested in a business, it hasn't done well, all your assumptions have turned out to be wrong. So what is the next step? What do you do? Do you, go into denial mode and imagine that things will turn around, or do you just sell, take the loss, turn it into a tuition fee, and hope that you don't make the same mistake again? So the same logic that applies in the world of investing can also be applied to personal life situations, and it does help to have that framework forever.
Since you spoke of personal life situations and your mom, when you were young, what did you want to become?
I wanted to become rich. Now I want to be healthy, and I have started appreciating tranquility and peace. And I think that happens to everybody over a period of time.
Have you always worked for someone? Or, have you always been on your own? Always?
Pretty much. Yeah, I worked for American Express for 6 months, and that experience basically
Scarred you.
made me aware that I'm pretty much unemployable. Yeah, I don't think you will ever hire me.
I think that's a nice headline. Sanjay Bakshi on why he's unemployable.
Sure, if you want to use it.
Okay, and my last question to you is, you interact with a lot of very young people as a professor. What
Yeah.
is the one thing that you would love to impart to them, that you want your students to become?
Well, okay, let me tell you a bit more about my experience. So, I started out by teaching MBA students, and now I'm teaching undergrad Gen Z students, and it's a very different experience. You learn a lot by being in the classroom when you're interacting with people who come from a very different generation. They have very different worldviews, and they look at businesses also in a very different way than you do. So you learn a lot by being with them. What I do want to impart to them, to the young ones, is to, the problem that I see, the young ones, they don't have attention spans, beyond that of a goldfish. So they're always looking at screens and Instagram, and it's very hard for me to, or anybody, to get them to sort of concentrate on a single idea and do long form writing or reading. They can't read beyond 2 or 3 pages at the most. So it's a hard to do, but it's a very important skill to acquire. And to acquire that skill, you got to know what not to do. So you have to keep the phone away, and you have to keep all distractions away. And the world is full of business models which thrive on distracting you from whatever you're doing, whether they are notifications or whether they are messages from your friends and so on and so forth. So to shut it all down, and I show them how I do it. I don't know whether it'll work or not, but that's the one thing that I would tell my young students, that learn to focus, and to yeah, and they, in that field, meditation helps a lot, because meditation, what is meditation? Putting your mind to one thought. Could be a flame, it could be the word om, it could be a mantra, could be anything, and not letting your mind wander away. So it's not the mantra or the flame or the thought, it's the practice of holding your thought on one object and one idea, and going deep inside that idea. And that's a skill to acquire, I think, for anybody.
Oh, that's lovely. That's really nice. I needed to hold my meditation skills, so I can well resonate with that.
Thank
So,
you.
Professor, thank you so much for your time. I really do appreciate you talking to me today.
Thank you, Larissa. Thank you so much, and have a wonderful weekend. Yeah.
This is Larissa from Morningstar. Thank you for watching.